Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors citing GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the citing GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
Hello and welcome to the Global View. On this Friday, I'm Andrew Gagan. Good to have you with us again here at Ausbiz. Let's get across what we saw overnight. Global equities finishing in the red. European shares at three-week lows, in fact. Now on Wall Street, the main indices fell on data showing the economy grew faster than previously estimated in the second quarter amid strong consumer spending and business investment, and with more Fed members urging caution about cutting interest rates too quickly. Well, among the mega cap tech stocks, we did see Apple rise. That was the pick of the bunch there. Nvidia also ending in the green. Big box retailer Costco reported after the bell and beat fourth quarter revenue and profit estimates as Americans looking for bargains flocked to the membership-only retail chain. Shares of Accenture fell even after the consulting firm reported revenue above expectations. CarMax shares plummeted after the used car retailer reported a lower second quarter profit. In Europe, Swedish fashion group H&M reported a bigger than expected rise in third quarter profit. And elsewhere, German sandal maker Birkenstock raising expectations for fiscal 25 revenue, driven by demand for its clothing and shoes. Well, the US economy grew faster than previously estimated in the second quarter amid strong consumer spending and business investment, although momentum appears to be slowing as the effect of tariffs become evident. Gross domestic product increased at an upwardly revised 3.8% annualised last quarter, the fastest pace since the third quarter of 2023. Meanwhile, the number of Americans filing new applications for unemployment benefits fell last week, but the labour market is obviously losing momentum there amid an anemic pace of hiring. Now, Fed Reserve Chicago President Austin Goolsbee has said he can see further interest rate cuts if inflation falls, but said, I'm just a little uneasy with too much front loading until we're sure that's happening. Whereas newly installed Fed Governor Stephen Miron has said the US economy is more vulnerable to shocks right now due to higher interest rates, based on what he refers to as unfounded inflation concerns among his Fed colleagues, saying when monetary policy is in that restrictive stance, the economy becomes more vulnerable to downside shocks, and added that there was no sign tariffs were driving inflation, saying that's what's holding up a lot of my colleagues. Well, US Treasury yields have gained following stronger than expected economic data. The US 10-year at 4.17, the 2-year up more than 6 basis points at 3.66, the US dollar. The index there up around 7/10 on the day. And the Aussie dollar has fallen back to 65.4 US cents. Oil prices have steadied after hitting a 7-week high in the previous session as Russia moved to restrict fuel exports until the end of the year. Brent futures marginally higher at $69 a barrel. Copper fell more than 1%. Iron ore little changed at $106 US a ton. And gold paired earlier gains after the stronger than expected US economic data. Spot gold at around $3,750 an ounce. Meanwhile, silver rose above $45 US an ounce for the first time in 14 years, bolstered by a risk-off mood in equity markets and ongoing concerns about the trajectory of the US economy. Spot silver rallying more than 2.5% overnight and is up more than 50% this year. Let's get across what's moving at a macro level and how that's influencing particularly those risk assets at the moment. John Blank joining us from Zacks Investment Research. John, welcome back. Good to see you. What did you make of that latest economic data, where the US economy is sitting right now? And of course, we'll get to that that battle that's going on within the Fed at the moment?
Andrew, I took a look just before the show at the BEA output, and what you learn is the revision upside was actually in consumption, and it was material, and it was very large. If you look further into it, it was driven by goods producing, not service producing consumption. And what that tells us is that people bought in front of the tariffs, just like businesses bought for inventory. So I think the real story here is there was a rush to buy things in front of tariffs in the United States, and that makes a ton of sense. And we're starting to learn that in these chaotic situations, revisions can be very material because these are unprecedented or unexpected moments in the U.S. economy. So I think the real lesson here is consumers were just like businesses in their savvy and saying, hey, I need to buy a car, I need to buy a washing machine, I need to buy new carpet, whatever it was. People got out there and did it in advance of these tariffs.
So the question, though, John, remains as to whether we're going to see continued effects of those tariffs, perhaps passed on to the consumer. Now, this is certainly what the Fed members are debating at the moment. What do you make of what has developed really into two separate camps here within the Fed? Those advocating for a watch and hold stance, and those saying they're way behind at the moment, they should have cut earlier.
Yeah, Andrew, the real gist of the whole matter is found in the summary of economic projections for the 2026 median dot plot. What you find is basically seven voters out of the 16 were at 4% for the rest of the year and will not cut because they see 3%, let's just keep it simple, 3% core PCE, core CPI in the United States, and say, look, 1% real rates at this point in time is all we're willing to do until that moves. And that is a very sanguine statutory mandate and saying we haven't finished our job here. The other part of it, the other 9 are saying let's cut, and Moran, of course, he's just a stooge for Trump, so he should be just thrown out for a worry war situation where the Fed is longer independent. So he is more concerning than helpful, and the other 9 of them are basically telling us that they have to wait and see how the labor market performs, because one of the things we're learning here about the tariffing is that it's multi-dimensional, and the real simple feedback that a tariff is going to raise prices is sort of being disassembled into a story that's much more complex. Lowering profits, lowering job entry level jobs, probably holding off CapEx, probably getting some of the importers to eat some of the tariffs. So until we know, more granularity, and frankly, just like we saw with the GDP report, it's going to take time. People are jumping to conclusions that, oh, you know what, there's no effect from an 18% effective tariff rates in all the imports in the United States. That's absurd, Andrew. But what we're learning is how the market responds in a granular sense across all those imported goods is going to have to be, figured out. And I think if it's not the case that the job market got hit, I'd be very surprised. I think the real lesson here may be that it's not prices per se, it's jobs that got hit by this tariffing.
John, just in the past couple of sessions, that momentum in the equity market has stalled. What's the market looking for now?
It's a good question, Andrew. I mean, I just did the current PE ratio for the large cap S&P 500 is almost 25 times earnings, Andrew. And that's last, average of the last 10 years is like 19. So you're looking at a 30% overvalued market, Andrew. And you and I have talked many times, and we can talk again today if you want, about overpriced and overrun stocks. So, it just seems to me it's been a big, also kind of a pump and bumping in the finance space, boost up these momentum traded shares, do a bunch of IPOs, get a bunch of money out of the crypto businesses, and in front of this thing. So I feel very uneasy about the situation here, because I think it's going to be a spiky market that's kind of reflecting, some of the giddiness and that came out of, the Zweig bread thrust, if you want to be a technical guy, back in the period of the April Liberation Day tariff thing, and that just, the Zweig bread thrust did play out properly, and all the technical guys that I work with got real excited, and it's worked. But it's worked so well, Andrew, that now we're in a classic, almost climax top situation. So I would be very concerned about this market. I would not be a buyer of most of these stocks. I do find value, if you look into the kind of the non-tech names, but you gotta be aware of that the tech names are way overpriced.
Well, let's go there just quickly, John, with three stocks that you've come to us. The first one being in healthcare, Tenant. What are you seeing here?
Yeah, Tenant Healthcare. This is a classic story of a post-COVID movement to procedures. So everybody delayed going to the hospital, doing procedures during COVID. You can look at those earnings estimates. You can see them starting to ramp up in 23, 24, 25, even out to 27. So people held off on stuff, and they're doing them now. But again, if you look for a move out of a stock, 120 to 200 in 5 months, Andrew, for a hospital stock is absurd. So this is just, going to be exhibit A of the many ones we have. This is even not the worst offender, but just look at this one and say, okay, this stock is a hospital stock and it's pricing fair value at 2027. Right now, we're 2 years ahead of ourselves.
Second stock, Shark and Ninja. What do they do?
Shark Ninja, this is kind of your really novel, cool household appliances. So this is, they IPO'd back in 2023. You can see it's a really nicely positioned business. It's right out of Massachusetts. But again, you can see here the Liberation Day take us from 110 to 70. Now we're back to 120 and we're back at the 27 fair value. So again, you're just getting massive snapbacks on this. And now, I think in this case, because the growth trajectory is somewhat more, respectful, I think this one probably is, somewhat in line with its fair value, other than the one that Tenant. But again, Andrew, how much of this is the euphoria of the 2027 build? Because we know that, basically this is a really stagnant economy up here looking ahead.
Just very quickly, almost out of time, Evercore, that is a investment advisory firm. What do you see there?
Yeah, Andrew, this one, look at this chart. Again, we got to talk about stocks, not just indices, because this is exhibit A. 160 to 350 in 5 months. Just insane. And before the show, I looked at these 2027 outlooks. For whatever reasons, these analysts are doubling earnings for Evercore because they think there's going to be this AI IPO boom that's going to come out of Evercore. That's unproven stuff. A doubling of earnings is absurd. But again, look at what it did. The pump worked, and it took the stock from 160 to 350, Andrew. So again, I'm a seller of Evercore at this point. But you can see, Wall Street is loving this market because it's active and it's got a lot of, juicy prices to stick price tags on a lot of securities out there.
John, always terrific stuff. Thanks for getting us across that. Thanks for joining us from Zacks.
You bet, Andrew.
Quick look at where we're likely to start with about a minute until we get going. We are up marginally as far as SPY futures, so marginally higher. Stay with us because we're going to get right across that in just a minute.